Look, can I tell you something? For a long time, I used to think the same thing. If my paycheck was just a little bigger, all the money stress would disappear. But the truth turned out to be a little different. My income went up, and somehow, by the end of the month, my bank account still looked empty. And that feeling, it's strange. You're not broke. You're not irresponsible. But somehow, the money just doesn't stay. One evening, I was sitting there, opened my banking app, and started looking through the last few months of transactions. And that's when something clicked. The problem wasn't that I didn't make enough money. The problem was my money didn't have a direction. Every time a paycheck came in, the money just scattered everywhere. No system, just spending on whatever showed up first. That's when I slowly learned something. If you decide the order of your money the moment your paycheck arrives, half your financial stress disappears. In other words, your money needs a path, a clear order of where it goes first. So let me walk you through it, just like I would explain it to a friend, slowly. The first thing, the moment your paycheck hits your account, take care of your minimum debt payments. Credit cards, student loans, car payments, anything you owe. This part might not sound exciting, but if you mess this up, it causes real problems later. Miss a payment, and your credit score drops. And once your credit score drops, everything gets harder. Getting approved for an apartment, getting a mortgage, even qualifying for better interest rates. So rule number 1 is simple. Minimum payments always get handled first. Always. Now, the second thing. This one changed everything for me. Automation. Set up automatic transfers the day your paycheck arrives. Money automatically moves into savings, into investments, into an emergency fund. Why? Because there's a simple truth about money. The money you see sitting in your checking account eventually gets spent, but the money that disappears first gets saved. Automation removes the pressure of discipline. You don't have to remember. You don't have to rely on willpower. The system handles it. Your paycheck arrives, and part of it instantly moves where it needs to go. Now, the third piece, your monthly living expenses. This is the money you actually need to live your life each month. Things like rent or mortgage, groceries, utilities, gas, phone bill, internet, insurance. Now here's something important. Not every expense is the same. Some are needs, some are wants. Rent is a need. Electricity is a need. But ordering takeout every weekend, that's a want. A simple guideline that helps a lot of people is the 50-30-20 rule. About 50% of your income goes toward needs, 30% toward wants, and 20% toward savings or investments. It won't be perfect for everyone, but it gives you a clear starting point. Now, the fourth thing, your emergency fund. Life doesn't always go according to plan. Sometimes there's a medical issue. Sometimes your job situation changes. Sometimes unexpected expenses just show up. And if your account is empty when that happens, stress multiplies fast. That's why building an emergency fund is so important. A good target is about 4 to 6 months of living expenses. So let's say your monthly expenses are $3,000. You'd eventually want somewhere between $12,000 and $18,000 set aside. You don't have to build it overnight. Take your time. Start with a small goal, maybe $2,000, then $5,000. Then keep growing it slowly. Just remember, that money is only for real emergencies. Now, the fifth thing, high-interest debt. Some debt costs way more than others. Credit cards are the biggest example. Sometimes the interest rate is over 20%, which means that balance grows fast. There are 2 common ways people tackle debt. The first one is called the avalanche method. You focus on the debt with the highest interest rate first. For example, if you have credit card debt, car loan, and student loans, you would attack the credit card balance first, because that one costs you the most. Once that's gone, you move to the next one. The second method is called the snowball method. This one focuses on paying off the smallest balance first. It gives you quick wins. You see progress faster, and that momentum keeps people motivated.
Neither approach is wrong. The best method is the one you'll actually stick with. Because personal finance isn't just about math, it's also about behavior. Now, the sixth thing, investing. Once your basics are covered, this is where your future really starts building. Start investing consistently, even if the amount feels small. A lot of people wait. They think they'll start investing once they make more money, but the real power comes from consistency. If someone invests even a few $100s every month and keeps doing it for years, compound growth does something amazing. Over time, your money starts working for you. And finally, don't rely on only one source of income. The world changes fast. Companies restructure, industries shift, technology replaces jobs. That's why having a second income stream can make a huge difference. Maybe it's freelance work. Maybe it's creating content online. Maybe it's a small online business. Maybe it's teaching a skill you already have. You don't need to work 80 hours a week. Even a few hours on the side each week can slowly turn into something meaningful. And the extra money you make can go right back into your savings and investments. That's when things really start accelerating. Because here's the truth. Making money is hard. Everyone knows that. But managing money well, that's even harder. And sometimes all it takes is a little clarity. A paycheck by itself doesn't change your life, but the system you build around that paycheck absolutely can.